Here's an outline for what we're going to talk about. You can see that there on your screen. We're going to start with some preliminaries. So on this slide, you can see the topics and the preliminaries that we'll talk about before we get to the data topics themselves. We're talking about what economists call time series data. So what this is supposed to be is the same concept measured at periodic intervals. The technique that's being used at each interval should be the same along the way. For example, if I have annual data from 2011, the measurement technique for that number should be the same technique that's being used for that same data in 2012. However, this actually is not always the case. If the technique does change, as it sometimes does, we call this a structural break. It's something to keep in mind when you're looking at data over time. The next distinction with data over time is level versus growth. You can have a data concept like GDP where this one data concept gives you two different things. Example, the first is the level of GDP. So in 2008, US GDP was about $14.4 trillion. How many zeros is that? Just kidding. Type 2 is the growth rate. This same concept, US GDP, shows me that in 2008, the growth rate, 2008 quarter 4, excuse me, the growth rate was negative 6.5%. So I have two different things going on with the same data. Here's an illustration of level versus growth using a different data type. This is a median home price for single-family homes. This is the level. It's in thousands of dollars. The next slide shows the growth rate. It looks very, very different. It's the same data. It's just we're viewing this data in a little bit of a different way. We're looking at the level or we're looking at the growth rate. Generally, economists look at both because there's information, unique information from both. Given that we use data over time, and given that sometimes the data is measured differently or in different units than other data that we might want to relate to each other, we often calculate growth rates. Here's the basic formula for calculating a growth rate. I do put the formula for the decimal form here. However, for your audience and for yourself, it's best to always compute it in percent form. The previous formulas work well for annual data. They don't work very well necessarily from a macroeconomic point of view, what we call high-frequency data, that is quarterly and monthly data. Here are the formulas for quarterly data, and here are the formulas for monthly data. The thing that's going on here with these formulas is that a quarter-on-quarter growth rate or a month-on-month growth rate isn't an annualized rate of change. But people are used to thinking about growth rates in annualized terms. So the middle formulas on both of these slides take either the quarter-on-quarter growth rate or the month-on-month growth rate and annualize them. When they're doing the annualizing, they're using compounding. Why is this? This is because if I had growth in quarter 1 that was followed in quarter 2 by more growth, then I've got to build my new level in quarter 2 off of the level in quarter 1, right? Because quarter 1 grew as well. That's why we have to compound. For those of you who are used to financial calculations, this should seem intuitive. There's also what's called a year-on-year calculation, growth rate calculation. So in the example of quarterly data, what you can do is take quarter 4 of a year, like 2014, and do a growth rate over quarter 4 of 2013, the same quarter in the prior year. Now here, because it's a year ago, you don't have to annualize. It's intrinsically or automatically an annual growth rate. What the year-on-year growth rates can do, particularly for monthly data, is it can reveal a pattern more clearly because monthly data is very volatile. Here are formulas for deflating. Now, for some data sets like GDP, the government agency that promotes that data will do the deflating for you. However, there is some data where, like retail sales, for example, where if you want to see the inflation-adjusted numbers, you have to do that calculation yourself. When we do the inflation adjustment to data, we say then that's the real version of retail sales. We sometimes say we are deflating nominal retail sales in order to calculate real retail sales. Just some jargon there. So here's a slide that gives more jargon. Some of the government agencies that promulgate this data use this type of jargon for discussing whether the concept is real or nominal. Then there's trend versus cycle. So an example, the average growth rate of the United States economy from 1948 to 2008 was 3.38%. That's the trend. Cycle. Well, sometimes the growth rate was as low as minus 1.9%, and sometimes it was as high as 8.7%. Those are huge differences. If you look at charts of the growth rate, you can see the cycle. So we have a chart of the level of U.S. real gross domestic product here, and we have a chart of the growth rate. And in the chart of the growth rate, you can get a sense of the cycle. This isn't exactly the cycle. There is a fancy way to measure the cycle that's done by the NBER, but this gives you a sense of it. You can see where the data goes negative, and when it goes negative for consecutive periods, that's a pretty good indicator, although not perfect, that we are in a recession. We use various frequencies of data, daily, weekly, monthly, quarterly, and annual, when we look at financial and economic data. Sometimes you will want to convert frequencies, so you might have some daily frequency data and you would like to look at it at the monthly frequency. There are three common ways of doing this conversion. You can average the observations from the daily data to get, from all the days in the month to get the month. You can sum all of the data at the daily frequency to get the monthly number, or you can take the last month. Which conversion method you use depends on the type of data. So this slide goes through examples of the types of data for the conversion method. If you're using GDP, we typically average the data. If you're using things like building permits or the number of permits per month, then we take the sum, right? If we want to know the total number of permits in a year comprised of the various months in those years, we're going to have to add them up in order to know what the total number for the year was. With some financial markets data, like stock prices, the convention is to take the last observation. So if you're converting from daily to month, it's the last trading day of that month. If you're converting from monthly to annual, you would take the last trading day of the year. And that would become your number for your new frequency. Seasonality. Seasonality is a big deal in economic data. In some types of data, like building permits, for example, the seasonality is very strong. For many time series, the government will seasonally adjust the data for us so that we don't have to worry about the fact that there is a seasonal pattern there. But for some types of data, it is not seasonally adjusted. So there are acronyms in the industry, SA for seasonally adjusted, NSA for not seasonally adjusted. And that's something to watch for if you're downloading data or viewing data on your monitor. What can happen with this type of data is, if the seasonal pattern is strong, you can have a big jump from one month to the next, or a big fall from one month to the next. And you might think that it's a change of economic activity, but it might not be. It might just be a seasonal pattern that would happen anyway, regardless of the underlying economic activity. What can you do with data that's not seasonally adjusted? You compare the new number. Say August just came out and you're trying to compare it to July. Actually, don't compare it to July. Simply compare it to August of the prior year. The seasonal pattern in August is always the same. That doesn't change. So that gives you an apples to apples comparison. Here's an example of data that has a strong seasonal pattern. It's existing single-family home sales for the United States. And you can see quarters 2 and 3 are always stronger. Here's another type of data, agriculture data. Agriculture data has a very, very strong seasonal pattern, as you can see there. And the public sector as well. A lot of local public sector, especially, seasonal patterns come from the public school systems.